Is NNNREIT a good investment right now? A question stirring the minds of many investors. NNNREIT, a company with a solid balance sheet, but one that's facing challenges from rising interest rates and the potential of a weaker economy. It's a dividend stock with a history of consistent financial performance. Yet, in this current economic climate, it's more crucial than ever to understand its financials, business moat and dividend yield. Dive with us as we explore the financial depths of NNNREIT. Numbers don't lie, they say. Let's scrutinize the financials of NNNREIT. NNNREIT, a dividend stock, has been a beacon of consistency in the financial world. It's like that reliable old friend who always shows up. And yet, recent times have thrown a curveball at our trusty companion, with a slight dip in the adjusted funds from operations per share. To put it into perspective, we're talking about a decline of 1.2% year-over-year in the most recent quarter. Not a plunge, but a dip nonetheless. Now let's turn our gaze to the elephant in the room, the rising interest rates. They're like that unexpected guest who overstays their welcome, aren't they? Interest rates have been on an upward trajectory, and this has inevitably cast a shadow over NNNREIT's performance. The effects are twofold. Firstly, it has led to higher interest expenses, a bit like a toll gate on the highway of performance. Secondly, it's reduced the accretion from acquisitions. However, it's not all doom and gloom. NNNREIT has a solid balance sheet, a financial fortress, if you will. But here's the kicker. The company's cost of capital has increased. It's like the price of admission has gone up, and this has had an impact on growth rates. Despite these headwinds, NNNREIT is not without its defences. It has a manageable lease maturity schedule and has seen positive releasing spreads. It's like a sailor adjusting the sails in the face of a changing wind. The company doesn't have significant exposure to office assets either, which adds a layer of resilience. As we can see, the financial journey of NNNREIT is a compelling one, with its own sets of peaks and troughs. A crucial aspect for any investor is the dividend yield. How does NNNREIT fare in this regard? As we dive into the dividend history of NNNREIT, we find a consistently robust performance. This real estate investment trust has been successfully rewarding its investors with a decade-high 6.4% dividend yield. It's an impressive figure that certainly catches the eye and might make one sit up and take notice. But let's look beyond the surface. Over the years, NNNREIT has demonstrated a pattern of steady dividends, a testament to its financial stability and commitment to rewarding its shareholders. This stability comes from its solid balance sheet and manageable lease maturity schedule. However, it's important to note that in the world of investing, past performance is not a guarantee of future results. The dividend yield, although impressive, is influenced by a myriad of factors, including market conditions, interest rates, and the overall health of the economy. Recently, rising interest rates have created some headwinds for NNNREIT, with higher interest expenses impacting its growth rates. Yet, despite these challenges, NNNREIT has managed to maintain its dividend payouts, reflecting its resilience in the face of economic fluctuations. This resilience is largely due to its diversified portfolio and lack of significant exposure to office assets, which have been particularly vulnerable in recent years. In conclusion, the dividend yield and history of NNNREIT certainly adds another layer to the investment decision. It's a strong indicator of the company's financial health and its commitment to its shareholders. But as with any investment, it's crucial to consider all aspects, including the current economic landscape and the company's future prospects. So, is NNNREIT a good buy or not? As we've seen, NNNREIT has shown a consistent financial performance over the years. However, the current economic climate is causing some turbulence. Rising interest rates have increased the cost of capital for the company, impacting growth rates. This has led to higher interest expenses and lower accretion from acquisitions. In the most recent quarter, we've seen a slight dip in the AFO per share, declining by 1.2% year-over-year. The company also has a solid balance sheet and a manageable lease maturity schedule, and it has seen positive releasing spreads. This, in and of itself, is a promising sign. but it's important to consider the headwinds from refinancing debt maturities that the company currently faces. Additionally, NNNREIT does not have significant exposure to office assets, which might be a plus in these unpredictable times. However, the stock is trading at a reasonably valued level, but the case for multiple expansion is not compelling. Now let's talk about the elephant in the room, the potential risks. The main risks for NNN are the rising interest rates and the potential for a weaker economy. As we've seen, rising interest rates can negatively affect the company's performance, and if the economy weakens further, it could put additional pressure on the company. So, taking all of this into account, is NNNREIT a good buy? Well, it's not a straightforward answer. The company has strengths such as its consistent financial performance and solid balance sheet, but it also faces significant challenges, including rising interest rates and a potentially weaker economy. Based on the information we've dissected, it appears that NNNREIT is a moderately good investment right now. However, as always, it's important to do your own research and consider your own financial goals before making any investment decisions.